Hey there, dividend growth stock investors. Happy Friday to everyone. So this is the first video of its kind that I am going to do, and I'm going to do a lot of these moving forward. Every Friday, at the end of the trading day, we're going to analyze the spreadsheet that I have that has all 60 of the dividend growth stocks that this channel covers, broken down by the age range tiers of 1 through 4, if you're familiar with how I break those down. And wow, I mean, for the first of this type of video that I'm planning on doing, we have a massive, massive mover in the trading day with Nike dropping 20% in a single day. This is the largest single day decrease of Nike stock price in 23 years. And why is it dropping? Well, they reported that they're basically readjusting their expectations for sales for 2025. They don't think it's going to be as good of a year as they had previously anticipated it being, based largely by just how they're viewing consumer spending habits. And I totally get that. Money seems to be pretty tight for a lot of people right now, and maybe buying expensive name brand shoes is just not at the top of the list for a lot of consumers here in 2024. But wow, a 20% decrease in just a single day feels like maybe a bit of an overreaction from the market to me. But hey, we're going to get into this. But wow, what a huge drop. So, hey, before we get started, I'm just going to preface this by pointing out I'm not a licensed financial advisor. The opinions expressed in this video are my own, and you should always do your own due diligence before you invest in any stock, any security, any ETF. Check out the links in the video below to individual videos on the stocks in each of the 4 tiers that we'll be going over here today. And let's jump in. So I do want to take just a quick look at Nike. Here you see it's been down, and I'll tell you right now, in the tier 1 group for the investors of 18 to 30 years old, this morning Nike was already the most undervalued stock on that list of 16 stocks in my estimation, and then it dropped 20%. So, that's just kind of where we're sitting at right now. Nike is down 30% year to date, down 33% on the year, and this drop that it had today now means it's down almost 10% on the 5-year chart. So if you are in the market to add Nike shares at these current prices here in the mid 70s, you're getting it at least 2019 prices. So that is pretty wild. I do want to point out here, if we take a look here on Seeking Alpha and review some of the dividend information, just so everyone's aware of where we're at here. The dividend yield, and this is just the forward yield, the current yield is pushing 2% right now, which is way out of line with the 4-year average of just above 1%. If we look at the average dividend yields over the course of the last 10 years here, you can see Nike very typically yields in the low 1%, sometimes in some years not even a full 1%, but a lot of the times it's between like 1 and 1.25. 2024 has been a rough year. The average yield in 2024 already is pushing 1.5%, and it is quite a bit higher than that right now. So let's jump into the spreadsheet here. So we're going to look at the tier 1 stock group for the 18 to 30-year-old investors. And on my spreadsheet here, I've got a fair amount of information, but my green stocks here are in the 30% or more undervalued. Yellow is 20 to 29.99, and then red is everything else, so less than 20%. So anything yellow or green is stuff that I'm taking a look at and potentially starting or adding to a position. And the the 18 to 30-year-olds have just one thing in the green right now, but it is massively in the green, sitting here with a 1.96% current yield, 92.54% off the 4-year average. So this certainly looks like big time undervaluation. I mean, the dividend seems to be extremely safe. Payout ratio is just 39%. They increased their dividend earlier this year by just a little over 10%, which is in line with what they've done for quite a long time now. And I mean, hey, maybe the 4-year average. See, I update the 4-year average every couple of weeks. So this is a 4-year average from just earlier in the week when I went and updated all of these. Maybe Nike isn't a $100 or more stock for the next year, 2 years. I don't know. I mean, really, none of us knows. But maybe this 4-year average yield does start to creep up over the coming months, and this valuation starts to gradually look a little bit less attractive. But at just shy of 2%, this is a much better yield than you'll get out of the S&P 500 right now, and the dividend increase is certainly faster than what the S&P 500 usually averages. So this is what dividend growth investing is all about, you guys. Is being greedy when others are fearful. Obviously, there's a ton of fear in the market right now over Nike. I don't know how long it's going to take them to recover. But until they do, you can snatch up a pretty respectable starting yield off of a growth compounder year over year that usually averages in that 10% a year range. So there's a lot to like here. Sometimes being a dividend growth investor is just about turning off the noise, trusting in a blue chip company like Nike to weather the storm, which they have done throughout the years. Kroger jumped up on the list because they recently this week announced a dividend increase of 10.38%. So that jumped their current yield up a bit and put them in the number 2 spot on here. Anything from Kroger to Nordson to United Health to maybe Lowe's are all looking like pretty decent moves right now. I like Lowe's anytime it exceeds 2%, certainly. But wow, the story here on this one is Nike, no question. So let's look at our tier 2 group. So a fair amount of value here in tier 2. The winner of this group amongst our losers, right, is Hershey. So Hershey is down quite a bit on the year, and the main most consistent reason I can see is that just cocoa prices are pretty expensive right now. And Hershey stock is bearing the brunt of that, yielding just shy of 3% when the 4-year average is just 2%. So might be a really opportune time to start or build a current position in Hershey while it's down. Hershey went through a while there for a few years where it was just never on sale. It was never up here at the top of my bargain hunting list here, and right now it is. So that definitely has me excited. I added some to my Hershey position this week. Curious if any of you did. Starbucks continues to kind of take a beating right now. It's been kind of a rough year for Starbucks. Definitely down here below $80. It's pretty appealing. I've got a pretty large position in Starbucks right now, so I didn't add any to it this week. But I certainly don't think that it's a bad deal down here in the 70s. And then we'll round out the list here. Target certainly continues to show signs of undervaluation. The last couple of annual dividend increases Target's had have been pretty meh compared to what they've been doing for quite a while. And that could be part of it. And then it's just also, consumer spending is tightening up. So, stocks like Target are definitely feeling that a little bit as well. And then McCormick, certainly in a nice range here, comfortably above 2% when our 4-year average yield is 1.72. Good solid growth year over year on the McCormick dividend, kind of a sleeper. Don't see a ton of people talking about McCormick, but I definitely like the company. American States Water also yielding comfortably above 2% when it usually doesn't yield a full 2% historically. Uh, 68 years of annually increasing that dividend, usually about by 8 to 9%, an extremely consistent one. One of only 4 stocks in this group of 60 that's not an S&P 500 stock. And it's with very good reason. I don't need them to be part of the S&P 500 because their history of growth is just so solid. And then Next Era Energy had a rough one today too, dropped about 4.5% on the day here today. So they actually snuck up here into that green category and have put themselves in a position where they look like they're a pretty decent buy to me. I'm personally in this range right now, 31 to 41. I'm on the upper end of that range, but I'm definitely excited about continuing to build up positions with this group of 5 here that are in the green. So our tier 3 to 42 to 53-year-old investors, man, Hormel Foods. It's been a hard year for Hormel. They have dropped all the way down into the low 30s, yielding 3.71% when the 4-year average is right now at 2.4%. Now their payout ratio has crept up into the high 60s here at 67%, which could be a sign that their dividend increases are going to be a little bit lower. This next increase that they do might be on the lower side for what you might typically expect out of them in a given year. Definitely a good, solid company, though, which is why they're here on the list. 57-year annual streak of increasing that dividend. So Hormel at 30. If Hormel drops below 30, it's going to be really tempting for me to reach up here and grab some Hormel, because that 54% undervaluation is just kind of a screaming buy as I'm sitting here looking at. Archer Daniels Midland still trading pretty low. They had some drama with the CIO earlier this year that they fired. And that just caused Archer Daniels Midland stock at one point earlier this year to tank all the way into the low 50s. They've recovered a bit since then, but still showing plenty of signs of undervaluation. They just became a dividend king this year by hitting the 50th consecutive year of increasing the dividends. And they did it with a 12% banger of an increase earlier this year in the midst of all that drama. So definitely still liking Archer Daniels Midland a lot. American Tower Corporation. It's been a hard year for REITs with the higher interest rates, and American Tower with the funds an AFFO operating funds here. This is how you factor the REIT payout ratio, 62%, pretty low for REITs. So that one's not looking too bad. And then Medtronic just continues to just be in a slump. This 4-year average has just continued to climb month over month. But definitely a quality company creating medical devices and equipment, and certainly one to continue to keep an eye on, especially if you need to build a position in the medical or the pharmaceutical industry. And then Johnson & Johnson and Pepsi, 2 absolute stalwarts here in the yellow. Stocks of this quality, when they're in this 20 to 29% undervalued range, I'm generally pretty good about thinking that that's a good time to add on to those as well, because they aren't going to go up into that green 30% overvalued too often. And then we're going to wrap up here with the tier 4 investors of 54 and up. Only 10 stocks here, and not a ton of bargains. Realty Income, to me, looks like the best one out of this group so far. Realty Income, again, it's a REIT. High interest rate environment is tough for the REIT sector. Realty Income yielding almost 6%. I think that dividend, though, is pretty safe, pretty comfortable. 74% payout ratio on the REIT. 26 years of increasing the dividend. Great monthly payer, a favorite in the dividend investing community. I like it at I like it at this level. It's not a screaming buy. So if there's some higher yield ETFs you'd rather focus on in this age range, maybe not a bad idea. Well, that's going to wrap it up for today's video. I'm Colby, the DGI Crab. Email me your questions at dgicrab@yahoo.com.